Welcome to Revere Asset Management's Your Money with Danny Stewart.
The market will always overshoot to the downside and to the upside.
And Don Vandenbord.
Because it's not how much you make in the markets, it's how much of that you can keep.
We have a big announcement today. But first, do you have a Garanimals portfolio? Do you remember when you were a kid in the 80s, they came out with like the matching, you matched the giraffe to the giraffe or the rhino to the rhino or the number 12 to the number 12, 3 to 3. And so you could take the pants and the shirt to mommy and say, Mommy, look, this matches. See, I'm a big boy. This matches, my outfit matches. So do you have a Garanimals portfolio so that an art major can construct your portfolio based on your risk tolerance, your time horizon, and then come up with a matching Garanimals portfolio that matches your color and your number and your type? Look, I've got nothing against art majors, okay? And look, but I just don't want them managing my money, my portfolio, unless, of course, they've done all the self-taught learning, investing, and trading. You can learn this from the School of Hard Knocks. But here's the underlying theme of this show. What is your advisor telling you? Okay. Are they talking about buy and sell rules? Are they a market technician? How many investing books have they read? Okay. Because this is about your money, not their money. Okay. So the only question I ask for you today is, does your advisor sound like Team Revere? Do they sound like us? If not, why? Because it's your money. All right, without further ado, Revere has found another advisor that fits in perfectly with us. There's not a lot of advisors that do the active CANSLIM methodology with some other stuff. And so we found an advisor who left pie charts or us and has found a home, okay? He started out as a CPA, then a CFP, then kind of a hybrid model, and now he's found Revere, and actually Don found him. So without further ado, Don is going to introduce Todd. So Don, take it away. Tell us about Todd and how you found him.
Yeah, about 3 months ago, I got a text from JT over at Ticker Monkey. And he said, we've got another advisor in here that's looking to get on with a firm similar to yours. And Todd was kind of a lone wolf working, as you said, at a pie chart and an insurance firm. And that's just not a good fit. They wouldn't even let him hedge sometimes. And it just, if you want to do what's best for the client, you can't be in that sort of an environment. So the conflicts with that trading style led him to us. We interviewed him. I drove down, met him. He lives less than an hour from Ted and Connor. So it's our fourth Florida advisor, and had a great meeting with him and really impressed with the way he dives into companies. And his name is Todd Thomas. Got your applause meter ready, Dan?
Oh, yes. Hang
there
on.
He is.
Let me get it right. All right, now I got the drum roll, Todd.
Well, thank you very much, Don and Dan, for that outstanding introduction. It's just awesome to be here with Revere. It's been an unbelievable 3 months just working with the team that Don and Dan have built. It's just incredible. But before I go into that, I'd like to just kind of give you a little background of where I started and how I got here. And, basically, as Dan said, I started off with a major in accounting back in 1996. Went to work for one of the big six accounting firms at the time, KPMG, Pete Marwick, and spent 2 years there. And although I really enjoyed accounting itself, I did not like practicing accounting. It was very boring, tedious work. And one of my friends from high school was working for a firm in Detroit, Michigan at the time. And he and I met over Thanksgiving one year, and he said, "Hey, I'm starting a new office in West Palm Beach, Florida." and I think you would be great at this business." And at the time, I had an account with them, and I was getting really excited about the market. And I decided to quit my job at KPMG, and I earned my CPA, and then packed up and moved down to West Palm Beach, Florida, for Oldie Discount Brokers, which at that time was America's first full-service discount broker. So it was a hybrid of both a firm that provided research as well as low commissions. And at that time, you had the wirehouses, and then you had a handful of discount firms.
Wow, you're dating yourself.
Yeah. So Oldie was an individual stock shop. All we did were individual stocks. And incidentally, in my 29 years in this business, I have never once been involved in a pie chart portfolio. I've always every one of my portfolios has always been stock based. So I never really believed in mutual funds and rarely used them outside of customers that came in and wanted that for their retirement accounts. But after spending 2 years at Oldie, the individual that brought me into Oldie moved on to a firm called Online Trading, which is now TradeStation Securities. But what made Online unique is they were the first company that offered Instinet, which was the first electronic crossing network. And Instinet allowed you to buy and sell before and after market open. And it also allowed you to execute big blocks during the day out, off the floor of the exchange, and you could bypass the market makers. And we advertised to institutions as well as high net worth individuals, and we allowed them to use Instinet. And I operated with, I got a chance to see how mutual funds place orders and executed large blocks, and that was a neat experience. But once TradeStation bought Online, they no longer had that business, and they didn't need brokers or any support in that area because they went totally online. I and my business partner joined forces. We opened up our own broker dealer, and we started a hedge fund. And we started that in late 1999, and we ran it for about 13 and a half years. And it was primarily a day trading fund, and my partner was a futures trader, so he traded futures in the fund. And we did extremely well with it. We actually put up positive returns in 2008, and ironically, the returns were made by buying the dips during the financial crisis drop. So we would wait for extremes, we would wait for just flush outs, and we would get long, and then we would sell into the relief rallies, and I think we made about 8 or 10% that year just doing that. But one of the downsides of what we were doing is we were counter trend trading. So when the bottom came in the spring of 2009 and the market really reversed, we were fighting the trend the whole way up. And it was just a powerful trend and recovery year, and we put up low single digit returns, and I found we were always missing the big turns.
Right.
So another one of my friends at that time said, "Look, you've got to get involved in CANSLIM and the IBD style. There's a concept called the follow-through day that will get you back into the market and get you on the right trend of the market." So I really started working closely with my friend, who was also a former Oldie employee, and he really tried and worked hard with me to change my mindset. And I had read Bill O'Neill's books back in the 90s, and I really loved it. And I found that a lot of our setups were based on, breakouts of bases and cup of handles and earnings gaps and all the above. But we were buying them, trading them after a day or two, and then leaving all the juice on the table. So, it took me probably 2 good years to reprogram my mind and get out of that day trading, that fade trading type style. And I adopted the IBD style wholeheartedly, and over the next several years was able to substantially increase my returns, and definitely had a handful of triple digit years, and I just found it to be a far superior system. So you know, basically in 2013, my business partner had some major health problems, and we really weren't able to continue with his futures trading. And the firm dynamics changed. The business was changing into an advisory capacity. We had a good run, but we decided that he was no longer interested in being in the business, so we shut down our fund and our firm. And I went to work for a friend's firm in Boca Raton, which is a boutique wealth management firm. And it's a fantastic firm with a great group of guys. I came in continuing to do the CANSLIM style. I was the only guy at that firm that did that, and they allowed me to do it, but it just wasn't a good overall fit. They were running more, ETF mutual fund portfolios, pie chart portfolios, and I just didn't really have any support or any interest from anybody in what I was doing. So I was just running my own group of clients in the CANSLIM method. And then, that's where I was fortunate enough to find Don through JT at Ticker Monkey, and it was just a godsend. I mean,
listen, Todd, when he reached out, Don called me and said, "Hey, this guy's down in Boca. We may want to meet with him." It's actually an advisor that actually sees like we do, because they're far and few in between, folks. And so I called you, Todd, and I started talking to you on the phone, and we started. And within 30 minutes, I could tell you were a good fit, because you understood everything I was talking about. Like, I'd regurgitate some of Don's stuff, and you picked up on it right away. And you actually said, "You mean what did you say? You said, "You mean there's firms out there actually managing money for clients like what we're doing?" And I said, you mean you didn't know there were firms out there that aren't pie charts or us? You thought they're all pie charts or us brokerage firms, and they are. That's the way they do it. That's the whole point of this show today, folks. The whole investment business is set up so that they can have a quote advisor, have you fill out a questionnaire, and based on your number, they go pick you a number 12 off the shelf or a number 15, and then they don't have to constantly monitor and watch it. Whereas we're constantly monitoring and watching it. Todd was on the morning call this morning. He gave his 3 or 4 best stock ideas. We're going to get to that a little bit later in the show. So did all the other guys. So did Don. So is your advisor in there in the morning, 2 hours before the open, doing this and then talking about it, or is he asking you for a tea time? I don't know. That's a good question. All right, Todd, listen, thanks. We're going to come back to you in for your segment in just a few minutes. Folks, I'm going to go to the mailbag very quickly, and then we're going to go straight to the team, because I want to hit this because we're heading into the end of the year. Okay, I'm going to toot my own horn a little bit. I got about 10 or 15 of these. I got a whole bunch of them, because we really did well this year. I'm just going to read one, okay? 1213 JB. Hi, Dan. Spectacular job this year. Please give my thanks to the whole team. Thanks and Merry Christmas. Me. Thank you for the kind words, and Merry Christmas to you as well, JB. So, folks, year to date, and I can always give facts. I can't give you forecasts going forward or anything else. So as of last night's close, Grotection was up 30.24% gross. I'm using the gross number because some people have a 1% fee or 1.2. We have a different fee structure we have for different people. But roughly the clients are up about 29% with a diversified portfolio. When I say diversified, I mean we manage drawdowns. So the way that you don't have a big drawdown is get undiversified and go to cash or gold or something and not have a whole bunch of positions when it hits the fan. That's the whole point. In any event, that's what we're here to talk about today. So I got a whole bunch of that. But when I say diversified, we have a defense, but it's not the diversification in what you're thinking about. That's the thing that's going to let you ride down 35% every 5 years. Revere offers you a better way. So I'm talking about with those returns, that's with no bear markets ever. So we're annualizing 15% long term. That's pretty damn good, because that's not the S&P. That's not a 60-40. Anyway, so in the show notes, there's articles about Trump's impact on client portfolios, the 10 value stocks for the long term. Goonlock's economic predictions for investors to watch. It's all about asset allocation, target date funds, lifestyle. It's not about the market risk or the market's time horizon. So heading into the new year, you should reevaluate everything, including your money, including Revere, including everybody out there. You should look at your advisors, okay? Does your advisor start screening stocks every morning? Are they looking at stuff, or are they offering you a tee time? Don doesn't play golf. So Don, I'm going to you now. Show us what you do, because you certainly don't hit a golf ball worth a damn.
No, that's true. I don't, Dan, but
he doesn't even hit a golf ball.
I just have to rely on my charm to get me by, not my golf game. Here's the S&P 500, and I talked in Thursday night's video about this 60-50 level. Let's draw some lines here. So this was the breakout level back at the beginning of December. We undercut it earlier this week, got back above it on Wednesday. Thursday gave some back a little bit and gapped up this morning. So, and Todd's going to talk about this a little bit. We've had two big semiconductor companies report this week, and it kind of lit a fire under the data center and chip and networking type names. But that gap up, so this marks the second time now, Wednesday being the first one on the rebound. This marks the second time that an attempt to clear the 6,100 level has been thwarted. So as of right now, it is 12:07 p.m. Eastern time. We're back below that 60-50 level. We're trading at 60.44. Doesn't mean, and it also some other things that I mentioned in the video last night. We're seeing long-term interest rates tick up, and we're also seeing resumed strength in the dollar. Dollar and rates had been dropping while we were having this nice run post-election. But they are headwinds for growth stocks. The broad S&P 500, the RSP ETF has been weak. One of the leading chip stocks and really the leader of this bull market, NVIDIA, has been weak. And I think what we're seeing with NVIDIA is just people taking some money off the table after a big run and it going into some other areas in that big AI data center theme. That theme is far from dead. But there are other companies, and NVIDIA and MRVL and Broadcom indicated that they've got massive tailwinds, and I think we're seeing some money flow into those and out of NVIDIA. But what we're looking for right now in the key levels is as long as we maintain this 6,000 level on the S&P 500, there's no reason to get overly concerned. The 21-day moving average, the 60-17 breakout level, and this 60-29 pullback level earlier this week, those have all held. The 21-day moving average is in here too. This is a very big support range that we're keeping an eye on holding. And as long as, like I said, the 6,000 level holds, we're in good shape. The problem, however, if you look under the surface, is that breadth is a problem. Here you've got RSP. This is the equal weighted S&P 500. It's really these big cap tech names that are holding the indexes up. The NASDAQ 100 looks extremely strong, but you can see the RSP, the equal weighted S&P, just unable to get anything going over the last 2 weeks. And right now it's pulled back and it's sitting on the 50-day moving average. This is another area of concern, and we want to see today's lows hold on the RSP. Let's go to the NASDAQ 100, because this is where all the strength has been over the last 2+ weeks. It also gapped up and has reversed this morning too, but is still positive on the day. So the bottom line is, this is a historically bullish month, but we had a very strong move coming into this month. The S&P 500 is barely positive for the month. The equal weight S&P 500 is down 2.5%, almost 3% for the month. The NASDAQ 100 is up over 3.5% for the month. The Dow's down 2%. The Russell's down 3%. So certainly a lack of breadth, and it really has been these big tech names that are holding the market up right now. As long as they hold it up above this 6,000 level, we're big index investors in part of the portfolio because it allows us to smooth the equity curve. It gives us a big overall picture about what's going on with the market. As long as we maintain this 6,000 level on the S&P 500, we're in good shape. The fact that has the 21-day moving average is now above that 6,000 level gives us, as I mentioned, some additional levels of support there. If that breaks, we may visit the 50-day moving average. And if that breaks, I would expect some additional weakness in leading names. You can't have 25, 30 names holding up the market. And that's kind of where this is kind of where we've pivoted to. We've seen former big leaders like Kava decisively break the 50-day moving average and then continue to go lower. So it's really a bunch of tech names, as I said, that are holding it up. Some leaders, after having big runs, taking a break and forming bases. This is just part of what the market does. It's part of sector rotation. But you can't only have the tech sector strong. Eventually, that'll catch up with the market. So that's really the key thing that we have our eyes on. Any questions on that, Dan?
No, I think that's awesome, Don. That was a wonderful review. By the way, I do want to mention one thing because Todd mentioned it, and I want to tie it all in. He was talking about when he was learning the CANSLIM methodology, the follow-through day, trying to get back in, folks. That is the holy grail of active management with defense. Getting defensive and knowing when to sell when your stops are getting hit, that's not as difficult. The difficult part is trying to get in off of a bottom early enough so you get in and catch the gains, but not get caught in a dead cat bounce, because a lot of rises off the bottom turn out to be false. They're not the real move. So how do you do that? That's really the hard part. And that's what Don actually did, that through sweat equity, through burning the midnight oil, figured out how to do that with the ETFs so that he can be more patient and wait to have that 4-day follow through with IBD rule. So anyway, all right, Don, go ahead.
Yeah, the two most important letters in CANSLIM are, first of all, the M, because you got to have the market at your back. And then once you have that, 75% of stocks are going to follow the overall trend of the market. The second most important letter is the N, because then we're looking for companies that have something new. They're growing sales. That leads to growing earnings. That leads to a growing stock price. And those are the ones we focus on when we've got the wind at our back in a strong market.
Right.
So I mentioned NVIDIA. Let's show this chart first. And focus on the relative strength, or in this case, relative weakness line. NVIDIA actually peaked back at the beginning of November. They reported a fantastic quarter in the middle of November, 103% earnings growth, 94% sales growth. But that sales growth is decelerating a bit, and so is the earnings growth from the prior two quarters. The street has gotten a much better handle on exactly what they're doing, what the needs are for all the data centers and the role that they're playing. And there have been other stocks that have been benefiting from this. But NVIDIA initially gapped up on its earnings report. That was sold within the first hour. And it's continued to trickle lower on a relative basis as well as on a price basis since then. You can see where we bounced back to levels where we were right before the earnings report, but the relative strength line did not recover that same level. So that means it's weakening on a relative basis. And we've now seen 4 closes below the 50-day moving average. Well, 3 closes and a lower low today. After initially gapping up on the Broadcom news and initially gapped up on the MRVL news earlier this week. And we're going to segue back into Todd now. He's going to talk a little bit about MRVL, which
Don, I'd like to make one comment on what you just said. So, folks, look at that chart that Don's got up with NVIDIA. And what he's saying is NVIDIA is weakening, but some other tech names or some other stocks are strengthening on a relative basis. So if you actually took some money off, I mean, unless you're trying to protect long-term gains, but if you tried to take some money off of NVIDIA and move it into some of these other stocks that are doing well, not only do you increase your return probabilities, you actually reduce your risk. So you're actually making more money, probably going to make more money with less risk. That's portfolio management. Sorry, Don, I just didn't want to let that go unchallenged.
Sure, good stuff, Dan. Yep, good point. So let's go to MRVL. You can see the big gap up on its earnings report last week. Follow that up with Broadcom this morning, adding more strength to the fire. And these are two chip stocks that are playing significant roles in this AI data center build out. Both of their conference calls were extremely bullish. But that bullishness in these two seems to be coming a little bit at the expense of NVIDIA. So, Todd, you want to take it away and talk about MRVL?
Sure. Well, basically, MRVL and Avago or Broadcom are both benefiting from the same trend that's happening right now in the data center. And basically, part of the data center players are known as hyperscalers. Those are the Microsofts, Google, Amazon, and Meta. Okay, so these are hyperscalers that are creating massive data centers. NVIDIA is the main GPU engine that is running the data centers, but there's now a push where Amazon is developing their own AI chip, and that's known as the Trainium chip. And they're on their first generation of Trainium. And basically, companies like Marvel and Broadcom are playing a major role in the build out of that technology. And we first started hearing about it in Amazon's call a couple of weeks ago, where Amazon was very excited about the traction that they're gaining with their Trainium chips. And they referenced in that call that they had gone back to their suppliers several times during the quarter to increase orders of specialty custom chips that help the Trainium function within the data center. Okay, so right away, MRVL was one of the main players in custom silicone. Okay, and you can see on Marvel's chart back before the earnings gap, where you had some gaps in that chart, and that was starting to gain traction on the Amazon announcements. And then, sure enough, when Marvel reported last week, you know, they substantially beat the quarter and guided substantially higher. And basically, all this growth is coming from the build out of these custom chips. They're known as ASICs, or application specific integrated circuits. And, you know, they just talked about this market being massive, and it's in like a 3 to 5 year major growth cycle. And Marvel referenced that this is a 30 to 50 billion TAM. But then Broadcom came out, and their CEO said it's a 60 to 90 billion TAM. So as a result of Broadcom CEO coming out and almost doubling what Marvel's CEO came out at, both stocks just exploded on that news today. So that is kind of the new area of the data center that these hyperscalers are investing in.
Good stuff, and they've got a lot of catch up to do as far as from a relative strength basis. I mean, they've had phenomenal returns, but not the returns that NVIDIA put up since 6 quarters ago. They first came out with this massive growth in their sales and earnings, and the projection for what they were going to produce over the subsequent quarters. That really kicked off this whole AI data center theme that was really started with ChatGPT. And it's really just a matter of a technology maturing and coming to a situation where businesses can actually take advantage of it. It's catching up to the need. The need's always been there. Now we've got the technology to take advantage of it. Great stuff there, Todd. We've got Ted has an interesting presentation. We are very fond of saying at Revere that we don't diversify, and that means that we don't just go into areas that are underperforming just for the sake of diversification. The I like to say it's like going to the grocery store and picking out rotten vegetables to maintain a balanced diet. We don't do that. International stocks have been underperforming the U.S. for a substantial period of time, but that doesn't mean that individual countries aren't don't have the capabilities of far outperforming or really underperforming the S&P. And Ted's going to talk about Argentina today. Take it away, Ted.
Yeah, so just going off Don's point of proper diversification, not diversification, I pulled up this market surge comparison chart just with a few countries, the emerging markets ETF, and then the S&P 500. As you can see when you just quickly glance at it. Oh, also, by the way, I started it at the follow through day, November 1st, 2023, until present day. And from then, this chart highlights the performances of each ETF or index. As you can see, the S&P 500 blows all other emerging market countries out the door. And in terms of diversification, regular asset allocators, pie chart investors, no matter what the action is in those countries, will have you or have parts of your assets in those countries. And oftentimes it is diversification because there's political instability, currency instability in many of those emerging and developing countries, unlike the US. So capital is definitely safer, quote unquote, less risky here. And honestly, more capital in the world flows into the US, into US innovative companies than anywhere else in the world. However, we do have one country standing out, and that is Argentina. And this is ARGT that tracks the Argentina basket of stocks. And the big change, the big N, you can call it, even though this is not a growth stock, it's still an N factor. And the N was Javier Milei being elected president of Argentina. And that was an enormous regime change, complete paradigm shift in how Argentina runs its government. Essentially overnight, it flipped from a socialist regime to a free market capitalist regime. And immediately, we'll look at the chart later, but immediately we saw massive inflows of capital into Argentina and as well as the individual stocks. You had Druckenmiller and many huge fund managers come out saying this is the next area to be in because of deregulation, stripping away many bureaucratic government agencies, reducing their deficit and their debt, and just opening up the country to innovation and capitalism, really. And of course, the world loves that, as we can see post our election as well. And this Argentina chart that has widely outperformed since November 1st, 2023, 120% return. And that just shows the importance of free market capitalism, really providing freedom to all groups of people in a society from lower class all the way to upper class. So let's jump right into the chart. ARGT. Javier Milei was elected, I believe, November 17th, and the next day, November 20th, we gapped up. And that you can call as a macro gap up, just like how we buy earnings gap ups and treat it the same way. And really, this ETF just has made a huge move up on that. Just so much expansion and capital flowing into Argentina. Deregulation has helped banks there tremendously. Innovation is ramping back up, and it's really dragging just enormous percentage of the population out of poverty. Their capita per GDP is rising because of Javier Milei's actions. And of course, their stock market has been a big beneficiary of that. One stock I wanted to highlight that was actually actionable 2 days ago or yesterday, and I did buy some for my portfolios, was YPF. This is an oil and gas name, and they produce natural gas as well as other oils in Argentina. Just wanted to talk about the technicals first. We broke out of this 6-month base on extreme power. In 3 weeks, we made about 100% move. As those familiar with our podcast, these black dots right here signal what we call the ants indicator, and that was kind of characterized by David Ryan. Essentially what that is, it tells us that institutions are heavily accumulating a stock. And the criteria, I'll quickly lay it out, is 12 out of 15 days up, 20% plus move within 3 weeks, and then on average 20% or more increase in volume. As you can see, if you just box this and then box the volume before, you can see there was a heavy increase in volume. And afterwards, a nice, strong momentum up move is nice, but oftentimes the digestion and the subsequent pullback is even more important because that tells us if institutions are selling the stock or continuously accumulating it. And this correction was less than 20%. I believe it might have even been less than 15%. And it really formed a textbook, model book, William O'Neill high tight flag, 100% plus move within 8 weeks, 2 weeks sideways, and then we broke out yesterday. And so far we're having follow through on increasing volume as well. So that is perfect breakout action so far, and just continue to monitor the future price action and volume action of the stock to see where it goes. And fundamentally, if you look on the earnings, I'm not sure why the earnings aren't showing up on my chart here, but it has triple digit earnings in the last quarter, mid to high double digit earnings as well. So it has the fundamentals, it has the macro backdrop from deregulation in Argentina. So, and it has the technicals as well. And that often is the trifecta, as I would call it. So I'm definitely quite favorable on Argentina stocks, as well as this one right here.
Ted, real quick. So, folks, it's not just about that capitalism is a little bit better than socialism, or it's not a political story. I'm talking about for your money. So here's what we're saying. For your money, if you're going to have any money overseas, first of all, you shouldn't, because America's the strongest country in the world. But if you do, it should be in Argentina or possibly India. There's only a couple of countries only that would warrant having money outside of the United States. Any other country, you're losing money and you're taking more risk. Let me say that again. If you have a diversified international portfolio, you are reducing your return and you're taking much more risk. That is not a risk. That's a terrible risk-adjusted return. That's why this is important, and that's what Ted's talking about, that diversification. So if you're going to own anything, it'd be Argentina, possibly China's heating up. All right, sorry, Ted, go ahead.
Yeah, that was a great thought, Dan. And to go off that, the risk-adjusted returns is definitely critical. People often talk about the more risk you take. Like in traditional financial theory, we talk about how, they discuss what you learn at business school, that the more risk you take, the more return you should get. But clearly, let me bring up that chart again. Like Dan said, you are taking on a lot more risk being in Mexico or India or United Kingdom, China, Brazil. But are you getting that return? I mean, in fact, Brazil, you're down 16% from the follow through day, while the S&P is up 43% about, and Argentina is up 120%. So taking on more risk does not guarantee more return, no matter who tells you that. And
Ted, I want to say that in reverse order, Ted. Ted is saying that Wall Street has always told you that you've been told to make more money, you got to take more risk. That's a lie. It's a lie. They're wrong, or they don't know how to do it. So that return I was telling you about, that 30% this year, the 15% annualized, okay, that's actually with no bear markets ever. That's with less drawdown. We have less drawdowns in the S&P. That's with less risk. So we're making market-like equity-like returns, but we're taking less risk to do it. And the way we're doing that is we just don't get creamed in a big drawdown. We're participating on the way up. We're trying to minimize losses on the way down. Sorry, Ted.
Yep. I mean, that's it for my section. I talked about the most favorable stock for me in Argentina, and then just the macro backdrop of Javier Milei in Argentina.
Ted, go ahead and keep the controls here, and we're going to segue to Connor. He's got a couple of stocks that he's going to discuss, and you can just go ahead and bring up the charts as he discusses it. Connor, take it away.
Yeah. So today I kind of wanted to walk through two recent trades and kind of like thought process and like, how I came up with it. So Ted, you can pull up a chart of FNGS. And the first trade that I took was via FNGU, but FNGS is the normal ETF. So the chart looks a little bit more cleaner. And so basically what the thought process here was that the thesis is that potentially into year end, there was going to be a rotation into mega caps, big cap tech. And there's a combination of reasons for that. First of all, if you looked at just the big tech charts in general, you had Apple looking to break out of a multi-month base. You had Microsoft that was holding at the 200-day moving average and had a power of 3 setup and a big downtrend line break, and it had plenty room to the upside. You had Tesla that basically is the strongest stock in the market right now, and then even Google, which Grotection owns right now, was offering a good risk to reward, and then it got that spark with that quantum computing catalyst. And so to me, all the stars were aligning for mega caps to move higher. And then go to the IWM chart, Ted. And what coincided with this was right around when mega caps started to set up, you had small caps were quite extended. And if you look back at the chart history of small caps, they like to run for 4 to 5 days and then they like to pull back. It's just a very choppy index. And that's just the nature of, oils, regional banks, and some of the smaller stocks in there. So as IWM was extended, the queues started to set up, and on around December 2nd, there was a subtle something that probably most people didn't notice, but if you look at that relative strength line, it actually hooked back above the 21-day moving average. And if you start to use that tool, you will kind of notice that when you start to get those early turns, that tends to lead to sector rotation coming in. And sector rotation is the lifeblood of a bull market. And as active traders, it's our job to find that. So that was part of the thesis. And then the other thesis was that if big institutions, big fund managers, if they want to get some performance into year end, where's the easiest place for them to go? And that's going to be big cap tech. And so that was the thesis. And then I think a key point to talk about is trade selection. So there's many ways to play this. Actually, you could have bought Apple, Microsoft, Google, all of those names, which have worked, but I chose FNGU. So on December 2nd, I took FNGU, and the reason for FNGU was that it also had Avgo and ServiceNow. Avgo is the leading semiconductor in the market right now, I'd say, especially after this earnings gap. And then ServiceNow is one of the leaders in software. So with FNGU, not only did you get big cap tech, plus you got some software and more semiconductors, and it has about the best range. If you compare it to TQQQ, FNGU tends to outperform. So that was the reason I went with there. And then December 2nd, I took it as it broke out of that downtrend line. You had the moving averages coiled up, and it was basically the yesterday's close was about a 4% risk. And given the nature of this ETF, it does have quite large ranges. So it was a really good spot that you could get in with less risk as it was very tight. So took it there, and it started to work pretty nicely. December 11th, I sold half of it as it was starting to get a little bit extended. Some stats there. FNGS was about 7 ATR extended from the 50-day. And then you looked at Tesla, Apple, all those were stacking 5, 6 ATRs above the 50-day. And look back, historically speaking, tends to be a good spot for stocks to cool off a little bit. And that quick, thrust rotation, might slow down a little bit. So sold half that day, and now just riding this one with a stop at 600, and it's a locked in gain with that stop at 600, and we'll see how it plays out. This was gapping up. It was up pretty nicely off the open with Avgo. Now it's kind of came back in, just up a little bit on the day, but we'll see if that thesis continues to play out as if mega caps continue to get money flow into year end. So that was that. That was kind of the process of that one. And then I'll talk about a loser. Upstart's one. Now this one's definitely been a little bit frustrating. Ted, if you pull up the Upstart chart. Okay, here we go. Upstart. So this one's a little bit frustrating. November 18th, I bought this one, and reasons being fintech stocks are very strong. They were in stage 2 advances, so a lot of upside there, favorable group. And this one had a really strong earnings gap, and we love to play earnings gaps. You can either buy the gap, you can buy the pullback, many ways to play, and you can get creative. So November 18th, I bought that as it was hooking around off the 8 EMA. And you can see it ran up quite nicely. Ran up about 25%. So it's sitting pretty good there. And then on December 2nd, it got a gap downgrade. And whenever I see a nice gain go back to break even, just a rule is to cut the trade, as you don't want to risk another gap down, because then you've gone from a nice winning trade to a potential 5 to 8% loser. And as you can see, this one's came right back up, and that's just part of the game. That's why I specifically wanted to use this one as an example, because as a trader, this is going to happen all the time, and it's our job to stay mentally in the zone and just focus on the next trade. But this one still looks great. It's breaking out of this base today, and if you look at the weekly, this weekly looks fantastic, and I'm sure it will provide other opportunities along the way to get back engaged with this one.
Connor, hang on. Listen, that's a great point. So Connor brought that up. Look, we're fully transparent here. We talk about our losers and our winners. Does your advisor talk about their losers? But here's what he's saying. One of the hardest things about in behavioral finance is you have a stock that sets up, you think it's looking good, and it did. And you buy it, and then it turns over and rolls over on you. You got to follow your rules, because if you say, oh, it's going to come back this time, that's the one time that Bob's your uncle and it's going to get crushed. So you follow your rules. Your rules are what keeps you out of big losses. Remember that. So then he's looking back Monday morning quarterback and going, God, coulda, woulda, shoulda, coulda. But you don't know that. Looking back, you know that. You don't know that going forward. But then it's hard emotionally to get back in on a stock that's give you a little nick once or twice. A good trader knows how to overcome that emotion. And even if he has 3 small losses in a row on that same stock, he's still willing to take a position on that stock. And then he gets that 30, 40% pop. And those 3 little nicks and cuts don't mean anything. That's how you know you've got a professional trader versus a retail wimp. I said it. Go ahead, Connor.
No, great point. That's really everything I had. And yeah, just like Dan said, is, small losses are the name of the game. And then those big winners take care of the small losses that you take along the way.
And look, I'm trying to pull back the curtain. So these guys are active traders, and they're using technical terms. And so when they say something like that, I want to make sure it doesn't get past the listener that may not pick up on what they're saying, because sometimes they say something very subtle and it's a gold mine, it's a gold nugget. So I don't really want to, I'm not trying to interrupt all the time. I'm just trying to pull back the curtain for the retail clients. Folks, here's the question, the underlying theme of the day today. Do you have a Garanimals portfolio that an art major can ask you a few questionnaire and say, oh, you're a number 12, so you get this for all seasons? Or do you have a seasoned professional that knows market levels and manages it actively every day and accordingly? Oh, and by the way, all of their money is in right along with your money at the exact same timestamp, price, and percentage of the portfolio. All of we don't have some of the skin in the game. All of our skin is in the game. So I ask you that one more time. Do you have a Pie Charts or Us portfolio, or do you have a professionally managed portfolio? Folks, listen, we have a special guest next week going into Christmas. Our longtime clients probably know who that is, but make sure you stay tuned next week. Folks, listen, if you like what you heard, if you like real market, raw data, not some polished marketing BS meant to sell you something, just go to Revere Asset. Up in the right-hand corner, there's a subscribe button. We're not going to spam your friend or browbeat them or anything. All they do is they get this podcast and they get our newsletter every day the market's open, delivered to them for free to see how we feel about what the market is telling us. Not our opinion, not our forecast. What the markets are telling us, and then actually what we're doing in our clients' portfolios and our own portfolios. Next to it is a Contact Us button. You can send me an email saying, please review my Pie Charts or Us portfolio and let me know why it's doing terribly. And you can always call us old school at 855 Real Wealth. Folks, we'll talk to you next week on Your Money. Not their money, your money.
Because it's not how much you make in the market, it's how much you can keep.